It's an all-time high bonanza as markets around the world continue to break records. We're also going to pour cold water on one of the scariest charts going around. We've got to Pimp My Portfolio with Matt Ingram from North Haven Financial Management as he reviews the portfolio of one of our community members. And we're closing out with a question from a community member around ethical investing. We're going to have a look at the ETF DZZF and where ethical investing is currently at. Welcome to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
Oh, I'm very good, Bryce. Very excited for this episode. There is a lot happening in markets, a lot happening in this episode. So let's get into it.
News and markets.
All right, Ren. Well, two news stories today, all-time highs. It's hard to stop them. And we're pouring cold water on one of the scariest charts in the world. But let's start with a bit of a around the globe on markets.
Yeah, I think if this isn't a reminder to get invested and stay invested and invest globally, then I don't know what is. Because despite all of the concern, despite all of the noise, all of the questions, markets once again are hitting all-time highs.
Unbelievable.
So last week in Australia, we reached an all-time high. The ASX 200 crossed 9100. Don't worry about the index levels. Just worry about the fact that it was an all-time high. 21st of October was the date. The ASX 200 is up 10% this year. And then this week, we've seen the US, the UK, and Japan all hit all-time highs. And a lot of this story started in the US with inflation coming in softer than expected. Inflation for the 12 months to September was 3%. Economists expected 3.1%. So there's two ways to look at that. One way is inflation in the US now has a 3 in front of it.
Yeah.
First time it's had a 3 in front of it since January. So that's the bad news. The good news is it was lower than expected. Investors decided to focus on the positives, real glass half full situation. They also are basically locking in a rate cut, which we'll know in the coming days after we record this.
Yep.
So the US hit all-time highs. The S&P 500, America's 500 largest companies, now up 17% this year. But the tech-heavy NASDAQ 100 up 23% this year.
Unbelievable.
To flick over to the UK, it's had a good year as well, surprisingly, given the ongoing political and economic challenges the country faces. But remember, the stock market is not the economy. And the UK stock market in particular is not the UK economy because so much of their largest companies earn so much of their money outside of the UK. So while the UK economy might be struggling, the UK stock market is flying up 17% this
Finally.
year. But that all pales in comparison to another country that has hit all-time highs. Japan, the Nikkei 225 crossed 50,000 for the first time ever. That index level they've never reached before. Japan is up 29% this year.
Yeah, I mean, we've spoken about Japan recently. What a turnaround story. It's had decades and decades of negative or anemic growth, and great to see that it's back. I think a lot of people would now be wondering why a lot of our ETFs are Asia ex-Japan. You can get exposure through specific Japan ETFs, but what a crazy year it's been for Japan.
Now, that 29% for Japan, the year isn't even done yet. You would think surely that's been the best performing market in the world. It isn't. Hong Kong has actually done 34% this year, but it hasn't crossed its all-time highs. I think back in 2021, it was higher than it is today. Well, I know it was higher in 2021.
Yes. I just look at those numbers. ASX, for me, you've got to question being too overly exposed. Very rare that the ASX 200 beats the US counterpart. And I think
in our lifetime, yeah.
In our lifetime, yes. But good to see. I think if you, to your point, Ren, if you weren't to see those numbers, but you were to look at the headlines that we've seen over this year and the disruption that is going on globally, both geopolitically and at a technology level as well, you probably wouldn't expect to see numbers like this. And again, if you're not invested and you're trying to play and time the market, you're missing out.
Well, I think like a really common question we're getting at the moment is, is now the right time to start investing? Like, should I just wait? Markets are at all-time highs. There's a lot of talk around, there's a bubble. We've seen some questions in our Facebook discussion group around, should I be investing in the non-leveraged version of an ETF and then wait for the market to fall and then buy the leveraged version? All valid questions, but I think the thing to keep in mind is that no one knows where the market will go in the short term. And right now, the market is being driven, particularly the US market, is being driven by companies that are massive, that are unprecedentedly large, but are also unprecedentedly profitable.
Yeah.
And there's real dollars backing up some of these valuations at the top end of the market. No one knows what's going to happen in the short term, but I remain confident in the long term that the market will do what it's done for the past 125 years in Australia, which is consistently grind upwards. And, as companies get more productive, as new companies come to market, also, as inflation, devalues the dollar. But I'm confident that the stock market will continue to be the best refuge from the forces of inflation.
Big time.
And so...
Or gold.
Gold, property, any investable asset that holds its value against inflation. Yeah. But to people who ask, is now the right time to get started? My answer is yes.
Yes.
The best time to get started... What is it? Best time to plant a tree was 20 years ago. The next best time is now.
Yes.
Block out the noise, consistently invest, dollar cost average in good times and bad times. Your future self will thank you.
Love it. I want to move to a chart that has been doing the rounds.
We've just tried to dispel fear, and now
this is a scary chart. No, look, this chart's been doing the rounds and has been, I guess, scaring a lot of people. What it does, it overlays the S&P 500 return, and then it overlays it with total job openings in the US.
Yes.
And it throws a line at the point in which ChatGPT was released in late 2022. Up until that point, job openings and the S&P 500 have tracked each other relatively similarly.
Yeah, the chart goes back sort of 20 years. Yeah, and they've strongly correlated.
Huge correlation.
As the market is up, the economy's good, the companies are hiring, job openings are going up. As the stock market falls, the economy's bad, companies stop hiring, and so job openings fall. Those two lines... Which kind of dispels
the whole the stock market isn't the economy. But anyway...
They're correlated.
They're correlated. However, at the point at which ChatGPT was released, for the first time, that correlation disappears and the lines severely diverge. So much so that since that point, the S&P 500 is up 87%, but total US job openings have dropped by about a third.
Yes.
So one way to look at this would be to say, well, this makes sense. ChatGPT is destroying jobs. People are getting fired everywhere. And companies are now, instead of hiring, are turning to AI to take over human functions.
Yeah, well, even if people aren't getting fired everywhere, the companies just are hiring less.
Yeah. I mean, to put some numbers to the firing side of things, Amazon are laying off 30,000, Accenture 11, Microsoft 9. Like, there are big companies around the world.
So there are people being laid off.
There are a lot. Intel slashing 25,000. Meta itself is even reducing a number of employees in its AI part of the business. So you could look at that and say, well, that makes sense. But I think if we were to look under the hood a little bit further, there's more to it than just AI.
Yes.
At the point that ChatGPT was released, we were sort of mid-interest rate rising cycle, because earlier in the year was when the Fed first started raising interest rates. March 2022 was the first increase in interest rates.
And November 2022 was when ChatGPT was released.
Yes.
Yes.
Yeah.
And so what you're saying is that the job openings were actually affected by...
Well, there's more to it than just the release of ChatGPT. Like, economically, things like increases in interest rates are designed to make companies slow down on hiring and investments.
Yeah. I think I was kind of directing to that point. The job openings chart actually peaked in March 2022.
That's right.
When interest rates
increased. It was already
increased.
declining.
It didn't peak in November 2022 when ChatGPT was released.
That's right.
Thinking through the logic, like the idea that this tool is released, no one has any idea what it is, and at that point, companies already stop hiring. Like, you would expect there to be a lag effect as people figure out what the hell this thing is. So it has been called the scariest chart in the world, and I think we want to just pour a bit of cold water on it.
Yeah.
But the underlying point is probably a fair one. Like, even if this chart is maybe a unfair representation of it. There's no doubt that companies are slowing down hiring,
No doubt.
that list that you gave, companies are making people redundant because of AI.
Yeah, particularly, and we've spoken about on the show, in the earlier career area of the market, we're seeing like a larger proportion of unemployment or a slowdown in hiring, particularly for sort of graduates and whatnot out of uni. So I think this chart will be probably more illustrative in probably 2 or 3 years.
Do you want to know what my conclusion is? And, this may be a case of to a hammer, everything looks like a nail, but my answer to this chart is you have to invest, because there is an internal tug of war between capital and labour, and where the excess returns from the combination of capital and labour go, and capital has been winning that battle with small parts where labour has taken a bigger share of the pie over the past 100 years. But this AI is a point where capital is again going to take a larger share of the pie. And unfortunately for people like us, we don't have much of an opportunity to be owners of capital. But what we do have the opportunity to do is own a small piece of that capital through owning shares, through owning the companies that are going to take bigger and bigger shares of the pie as labour's bargaining power gets weaker, as the labour required to generate these returns for most companies gets smaller. Labour is going to get a smaller share of the pie. That's our work. That's our ability to bargain for higher salaries. You need to be an owner of capital if all these AI predictions play out and they just, create these ungodly amounts of wealth for smaller and smaller amounts of companies. You have to be owning those companies. It may be to a hammer, everything looks like a nail, but to us here at Equity Mates, this is just another reason you should be investing.
Love it. Well, to keep up with all of the news headlines, make sure you subscribe to our daily newsletter. We'll put a link in the show note. There's also a podcast that accompanies it. Every morning we'll send you the most important business headlines from around the world straight to your inbox or wherever you listen to your podcast. So make sure you're subscribed.
This is Pimp My Portfolio. Pimp My Portfolio.
This is a segment where we get a community member to submit their portfolio for one of our experts to review and provide some ideas on how they can improve it. And in the studio today, we have Matt Ingram. Matt, welcome.
Thank you.
And on the line, we have Vanessa. Vanessa, welcome to Equity Mates.
Hi, guys. Good to be here.
Thank you for submitting. We're looking forward to this one. So as always, Ren, why don't you take us through Vanessa's portfolio?
All right. So Vanessa has 10 holdings in her portfolio. We'll start with 3 ETFs that make up 44% of the total holdings. So we've got VHY, Vanguard Australian Shares High Yield ETF. That's 19%. Then we've got Vanguard MSCI International Shares ETF, about 13%. And then iShares S&P 500, about 12%. A number of individual stocks, 6 in total: NVIDIA, Alphabet, Macmillan Shakespeare, Origin Energy, Rio Tinto, and Yancoal Australia. Then finally, the final position, a small holding, the VanEck Bitcoin ETF. Interested to hear what Matt thinks about that one. So Vanessa, before we get you to explain the portfolio, we like to get our expert to give the portfolio a nickname or to characterize it in some ways. So Matt, over to you.
I don't know if this is going to make much sense, but I saw Shakespeare. And I've also seen there's the VHY, high dividend yield. That I've called this one to pay or not to pay. That is the question.
Nice.
Nice. Well, Vanessa, why don't you take us through how this portfolio has come to be over your investing journey?
Okay, so I started in 2022, like early, so it's quite a recent portfolio. And I bought 3 stocks, which was ANZ at the time, VHY, the ETF, and IVV. So just a third each. And then I just didn't really touch it until last year, where I bought my property. So I had some leftover money, like a bit of money to invest. And at the time, I was very interested in debt recycling. So I decided to buy a bunch of them with dividends, so I could then use the debt recycling. And from there, I just bought some extra stocks as well.
Nice.
Does it make sense?
Yeah, that makes a lot of sense. How have you gone about buying the individual stocks? What's been your thought process?
So just looking at the highest dividends, but also the growth in general. So finding companies that are actually growing, but also giving good dividends for the debt recycling. And then after buying 3 or 4 of them, I was like, I just need to buy Nvidia or Google because I just can't keep buying the Australian companies. But then I discovered that Nvidia actually has a really small dividend, so it qualifies for the debt recycling, which is great.
Nice. So, Matt, what are your initial thoughts for Vanessa's portfolio?
Yeah, a bit of context helps there. It seemed like an odd mix initially, having the VHY, which is obviously a higher yield play, mixed with things like VGS and IVV. Coming from that debt recycling approach, it makes sense. I think just more generally when considering that VHY holding though, I mean, Vanessa, I don't know much about you, what stage of life you're in or whatever it might be, and understand why you have VHY because it's that debt recycling. But just considering that, even with debt recycling, I understand the idea is trying to get income so you can pay off your non-deductible debt. But focusing a little bit more on growth over time is going to achieve the same thing. All something like VHY is doing is taking your gains essentially, rather than them being reinvested in the company, they're paying it out as income and now you're being taxed on it at that point in time, instead of just getting some growth, getting a CGT discount, paying that down, and then, if it's part of debt recycling, paying off your non-deductible debt or whatever it might be. So things like VHY are typically reserved for if you genuinely need passive income as a stream to live on. I would personally be focusing a bit more on growth, depending on what stage of life you're at, but focusing a bit more on growth rather than just high yield, because you might not be getting the growth you need out of that.
And you're saying for Vanessa, she can still do debt recycling, but it's more tax efficient to do it in a way where you prioritize growth investments rather than income investments.
Yeah, I mean, you have to be careful to some extent, like when you're looking at what the funds are used for that you've borrowed and the deductibility of it, and is it income producing and so forth. But most of these growth ETFs are paying a dividend anyway. So you're still getting that little bit of income, but you're getting more growth out of it, which, longer term, depending on what your marginal tax rate is, it's probably going to be more tax effective to sell that later on and clear your non-deductible debt, and probably going to be more effective longer term anyway than just trying to get some big dividends along the way.
So, Vanessa, has the purpose of this portfolio been to really just use it as a debt recycling, or how have you been thinking about this longer term in terms of the growth side?
If it was just me, like if I was like following what I feel, I would just go for Nvidia and Google and
and you would have done very well.
Yeah, exactly. Well, when I look at the profit, like at today's date, like just Nvidia and Google are almost doing the same profit than everything else, even more.
Yes.
So it's just the way it is. But yeah, VHY. So, Matt, are you saying I should just put everything under VGS?
No, I mean, you've got VHY there already. You've got it going. I wouldn't, you could just leave that, but I wouldn't really be, adding to it. I'm just saying there's a case for focusing just as much on growth assets as there is on income assets. Traditionally, people think about debt recycling and focus on income, not realizing that you're probably missing out on a lot of the effectiveness of it by only focusing on income. So maybe just going forward, having a bit more focus on the growth side of things, knowing that it's still going to help you accomplish that goal of debt recycling.
Now, Vanessa, before we jumped on, there are a couple of parts of the markets or asset classes that you were interested to get Matt's thoughts on. So what specifically did you want to speak through?
Yeah, I was interested in buying some gold, maybe gold miners, and also some rest of the world, like ex-US, ex-Australia.
So what are your thoughts there, Matt?
Yeah. I wish you were thinking about buying gold a year ago because it's had a cracking run.
Instead of doing that recycling.
Yeah, I mean, with gold, if you're going to go down the path of gold miners, then I would keep it to probably a gold mining ETF. There's a few out there. VanEck have a good one, GDX. Yeah, you don't really want to, take too many bets on one particular gold miner. There's some big names out there, Newmont and so forth, that have done well. But yeah, a ETF for that. I look, gold. People thought it was getting pricey 6 months ago, and it keeps going. I think as a long-term holding in the portfolio, it's definitely worthwhile.
And do you prefer an ETF of gold miners or an ETF that has gold and tracks the price?
Yeah, a couple of years ago, it would have just been gold. As gold started to run, the gold miners were left behind, and it's sort of the way that they price things, and it takes a while for everything to flow through to them. So there was a clear opportunity 6 to 12 months ago to jump into gold miners, and we did that. So we kind of got that second wind, and then it became quite a clear case for silver. Silver often follows gold, and it was lagging, and so the case for silver sort of opened up a few months ago as well, and now that's at some highs as well. So it's really about the timing around it. But a little bit of both, why not? Bit of a gold ETF, bit of a gold miner ETF, and you're covering all bases.
And then what about, I guess, all world exposure? How would you think about that for Vanessa?
There's VGS, which has some allocation to the rest of the world, but it is, I think, 70, 80% US. So if you are keen on getting more than that, there's a few ways to do it. Obviously, there's kind of the Captrol VEU kind of play, which is everything except the US. So that would complement it quite well. There is you could go a little more direct with a Europe ETF and an Asia ETF, but you're maybe unnecessarily complicating things by doing that. Or you could take a bit more of a active play. There is a couple of active ETFs that have done phenomenally well that have global funds. So can I name?
Yeah, please.
Yeah. Tell us all.
Look, one that I really like at the moment, and we've met the fund manager, and he's very impressive. This is the Plato Global Alpha Fund. Now they have up to about 1,000 holdings in there, so it's a bit of an index approach, but they have short positions, right? So they protect themselves on the downside. So they've achieved something like, since inception about 4 years ago, about 24% annual return, taking that somewhat passive play, but also doing some very interesting things in there. So that's run by Dr. David Allen. They have an ETF, an active ETF that anyone can access. So that gives you that global exposure with a bit of downside protection as well.
Nice. So Vanessa, a couple of ideas to think about there. Gold miners versus just buying a gold index or ETF, I should say, and a few active managers to look at as well.
Now, Vanessa, before we wrap up, we have to ask about your Bitcoin allocation. So it's quite small. It's about 1.5% of your portfolio. So what's the thinking around Bitcoin, and why did you decide to do it as an ETF?
Yeah, I don't know. I just looked around, and it's more for playing, really, see how it's behaving. So far, it hasn't really been wow, I have to say. So
yeah, it's been a bit vanilla this
it
year.
Hasn't hit the highs that people expected it to. That's for sure.
What do you reckon, Matt? How when clients come to you and say, "I want some Bitcoin in the portfolio," how are you managing that?
Yeah, just like this, just a Bitcoin ETF. I think we need to acknowledge it for what it is. I mean, it's if we're going to treat gold like having that as an alternative holding in a portfolio, a few percent, then I don't see why we wouldn't do the same with Bitcoin. 1.3% is what this says you've got in there. That's fine. You could probably crank that up a bit. Depends who you're asking,
Okay.
I suppose. But I have no opposition to that or a slightly larger holding.
Nice.
There you go. Pump those numbers up, Vanessa.
Yes, more Bitcoin. Well, Vanessa, I think if we were to try and summarize what Matt has sort of said, it's obviously if you're pursuing the debt recycling, then some of the ETFs there, are providing an advantage, but don't do it at the sake of growth long term, because that still has some advantages as well, and might even get you in a better position later on down the track. So, but look, Nvidia, Google, two positions that I'm sure have done very well for you as well. So, so thank you for submitting today.
thank you.
We really appreciate you putting forward your portfolio, Vanessa. And if anyone else listening would like to put forward their portfolio, head to equitymates.com/contact. There's an information form there. And if you'd like to speak to Matt as well, or any of our handpicked advisors, head to equitymates.com/advice. Fill in the form and we'll put you in touch with the most appropriate advisor. But Matt, thank you so much.
Thank you.
M-O-N-E-Y.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, I've got a question.
Answered.
We're going to check in on where ethical investing is up to, and it's been driven by a question that's come in from a community member, Sass.
Hi guys, I love your content and also your book. I think it would be really cool if you could do an ETF explained episode on an ethical ETF such as Beta Shares, DZZF, Ethical Diversified. Thank you.
Well, thank you, Sass, for the question and for reading the book. Shameless plug for the book whenever we get the chance. Yes. Don't stress, just invest wherever you buy books. But we thought this would be a good opportunity to check in on ethical investing because there's no doubt it was the biggest topic of the moment 3 or 4 years ago. We got so many questions about it, but we certainly get less questions about it now. But there's a number of ethical products out there. So it's worth us checking in and seeing what the state of ethical investing is and giving people a quick primer if they're not familiar with this part of the market.
Well, let's rewind, Ren. 2019 sort of through to 2021 was, as you said, when we noticed, and I think globally there was just a huge increase in the demand for and also the products hitting the market that were pitched as ethical investing. Yeah. The whole doing good and doing well in terms of the returns that you were able to get through ethical investing was sort of the message that was out there at the time. And the Equity Mates community members were all over it. We couldn't talk enough about ESG.
Yeah, and I think that doing good and doing well, it rang true because at that point in time, ethical funds were doing as well as the index.
Yeah.
And in many cases were actually doing like half a point or a percentage point better than the index. Yeah. So that point was really strongly emphasized. And then 2022 happened.
Then 2022 hit. So firstly, we had the energy crisis once Russia and Ukraine kicked off, and that sent fossil fuels stocks skyward. I think everyone then started pouring back into those types of investments as it was absolutely printing money.
Yeah, it was fossil, it was American oil stocks, but it was also like Australian coal stocks had a real moment.
Everything. And the return profile of those versus ESG really started to diverge. We also had issues around underperformance because of that with ESG funds. There was an anti-woke backlash in the US, and there were a number of greenwashing scandals that started to come out, which is effectively where funds or products said one thing when it came to ESG, but the reality is their underlying investment strategy didn't actually match what they were saying. And so that really sort of poured a little bit of cold water on the trust in across the industry.
Yeah, in Australia, Vanguard, they were subject to the highest penalty ever for greenwashing, $12.9 million after ASIC took a case against them. And I think, when people saw the name Vanguard associated with greenwashing, it created a level of skepticism around the whole space.
Yeah. So that sort of brings us to where we are now, 2025. Dust has somewhat settled across the board. ESG certainly isn't the hottest trend as it was, but it is still here. It still remains. I guess trust is slowly starting to come back into the market. So about $1.5 trillion is invested in what I guess you could term as responsible investments here in Australia. The language is now more about sustainable investing, value-based investing, and no doubt that it's starting to pick back up a little bit here in Australia.
All right, so that's kind of the last 5 years' history. Let's get into what you need to understand about ESG investing, and then we'll close with
DZZF.
DZZF and performance. So when it comes to ESG investing, sustainable investing, responsible investing, whatever you want to call it, there's really two approaches that you need to be aware of. One is a negative screen and one is a positive screen. Negative screen is certainly, well, at least for the products available to us, we see more of it.
Yeah.
And so that is we are going to exclude companies that don't meet our sustainability criteria, whatever that may be. And that's an important thing to stress, that manager to manager sustainability criteria does differ.
Yeah.
Famously, Beta Shares back in pre-COVID, I think they excluded Meta from their ESG funds.
Sustainability leaders.
Yeah, and that was sort of controversial because everyone else had Meta in, they didn't. And so it is important to look under the hood if you want to invest ethically, because there is a wide divergence sometimes in what's ethical and what's not ethical. But at a principle level, negative screen says we have a criteria and we're going to exclude companies that don't meet that criteria. And so the obvious and easy ones are like fossil fuel companies or companies that sell weapons or, whatever else. And so then you just reconstruct the index, like you take the US index, but you've excluded Exxon from, the top of that index or near the top of that index. So that's a negative screen. A positive screen is where you invest in companies that are making a positive impact. And that might be a company that is sustainable already, or it might be a company that is currently not sustainable, but is working to turn their operations around, or is a company that is the most sustainable in an unsustainable industry. Yeah. So there are again, different ways to do it, but the logic there is what you want to do is support the companies that may not meet your criteria today, but you want to give them the capital and the support to change.
Yeah.
That it's all about investing in the change rather than having a black and white set of criteria.
Yes.
And only investing in companies that meet that criteria today. So that's positive screen, negative screen. And then you sometimes get hybrids of the two where they'll exclude whole industries, but then pick ESG leaders from remaining industries. But yeah, if you keep that positive, negative screen in mind, you'll go a long way to understanding your different options out there.
And as you said, so subjective in parts of it.
So subjective.
What you think. It's important as an investor, you need to ensure that just because they say ESG and sustainability, it aligns with what you believe that is.
Yeah.
All right, well, let's turn to Sass's question, which was asking us to have a look at...
a long run-up to actually answering Sass's question.
Sorry about that, Sass. But we thought it was important. She wants to know about DZZF.
Yes.
So this is the BetaShares Ethical Diversified High Growth ETF, one of Australia's largest ethical ETFs, and it is an all-in-one ETF. Now, what that means is underlying it is a number of ETFs that use BetaShares RIAA certified ethical ETFs as building blocks. Now, these are ETFs that have positive climate change leadership screens. So there's your positive, and also broader ESG criteria. So this is a blend. They use negative screenings and also positive screening as well in the underlying ETFs. In terms of the breakdown of assets, you've got 90% growth, 10% defensive, and that's broken down by about 54% international exposure, 36% Aussie, and then that 10% is in global and Aussie bonds.
Let's get to the performance question. How's DZZF gone? Now, you would think there is a natural comparator, which is DHHF, the BetaShares All Growth ETF, similar ticker, but that's 100% shares, whereas DZZF is 90% equities, 10% bonds.
Yeah.
So what we actually think the better comparator is the Vanguard Diversified High Growth ETF, VDHG. So a lot of codes going on here. So
because it's 90-10, same split.
Exactly. Yeah. So we're comparing BetaShares DZZF, which is 90-10, with Vanguard VDHG, which is also 90-10. Now, DZZF, its inception date was 15th of December 2020. So it's been going for just shy of 5 years. Since inception, it's returned 9.5% per annum. If you look at Vanguard's VDHG over 5 years, it's returned 12.3% per annum over that 5 year period. That is meaningful underperformance. It's almost 3 percentage points a year difference.
Yeah. It's pretty much like what value do you put on being invested ethically? That's the cost, essentially, of making an ethical investment decision. And there's nothing wrong with that, but I think just be very aware that by excluding fossil fuels, gambling, weapons, tobacco, but there's also positive screening in there as well, you're probably taking out a lot of companies that have driven the growth over the last 5 years.
Well, yeah, you have, because you've underperformed. Yeah. I think it's important to stress that we've picked a moment in time.
Yeah.
And that moment in time included some pretty good times for fossil fuel industries.
Fuels.
And there will be other moments in time where it's the opposite, like that sort of 2018 to 2021 period where there was a lot of optimism around renewable energy stocks, and I guess a lot of the opposite of optimism, pessimism around fossil fuel stocks, and so they underperformed, and so it was good to exclude them. So we have to acknowledge that we've picked a moment in time, and you pick different moments in time the results may be different. But I guess we can only operate with the information we've got and the track record that this fund has, and it has meaningfully underperformed.
Big time. Put that in a compound calculator and do that over 40 years.
Or should we do that to close this episode out?
Pretty good. Yeah. Well, while you plug that in, I'll just remind everyone that as we wrap the end of this episode, if you would love to, we'd really appreciate it if you could leave us a rating and a review in your podcast app. It should take you no more than 30 seconds, but we love getting your feedback. Also, if you're watching us on YouTube, leave a comment below. We love hearing from you in the YouTube comments. And if you could subscribe to our YouTube channel as well, we would really, really appreciate it. All right, Ren, well, to close out, what is the difference?
So I did $100 a week for 35 years,
Yep.
the average length, like the length of a career. 9% a year, $1.12 million.
Okay.
I mean, that's still pretty good.
Yeah.
Invest small amounts consistently over your working life, you can become a millionaire. That's the message. So 1.12, but bump it up to 12%. And you get 2.25.
Oh, more than double.
Yeah.
Wow,
So those small percentage changes in fees, small percentage changes in returns, compounded over an investing lifetime can really add up. And so, Sass, to answer your question, I would say think long and hard about the investment choice you want to make.
Yes. All right. Well, that does it for this episode. Thank you so much for listening. Head to equitymates.com/contact if you'd like to ask us a question. But otherwise, we'll be back next episode.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful. Equity.